I think that in this environment, those felt safe, or in the previous environment in 2020, those felt safe because there was an undercurrent of uncertainty as it relates to the reopening trade, as it related to what does business enterprise spend come back to, where are we from a consumer spending perspective. But I would also agree with Jim on, if you look at where these businesses are going to continue to drive earnings, I mean, that's really what we're looking for in the back half of the year. We're looking for earnings growth to support the multiple expansion that we've seen. And if I have to put my bets on what companies can continue to drive stronger earnings, even with a regulatory overhang, even with the results that they've continued to post over the last year or so, I would still look at some of these big technology names like Alphabet, like Apple, to be able to continue to grow earnings. And so I think it's important to differentiate. If you're focused on the fundamentals and you believe that there is going to be differentiation and a return to emphasis on top line and bottom line growth, I think that you have to have some of these quality tech names in the core of your portfolio. Do you need to reach for outsized valuations and expensive stocks in tech? Absolutely not. Jenny's right. You can find some things that are underpriced relative to their peers. But I do think that these still make sense from a core perspective. And what we're not seeing is what we were fearing last year, was that as we entered into this cyclical rotation, that people would be en masse selling their big tech stocks to fund purchases in areas like industrials, materials, and energy. We're not seeing that. We're seeing it come from the sidelines, which is exactly what we need to see to continue to see the indexes grow, because technology is 28% of the S&P 500. So we have to keep that in perspective.